The previous trading week was unexpectedly volatile. The market entered the new year, but factors shaping market trends remained the same. Once again, the strongest speculative moves stemmed from expectations of a monetary policy easing by the key central banks. The US dollar index tracking the dollar's strength against a basket of six other world currencies ended the previous trading week with a 1% gain to settle near the 102.50 mark. The asset hit a three-week high of 103.10 after macroeconomic data confused investors and raised questions about the Fed's policy shift. Markets priced in a 70% chance of the regulator cutting rates in March compared to 90% a week earlier. Besides, Friday's employment report from the US Labor Department, which showed an unexpected pickup in earnings and a bigger than expected rise in non-farm payrolls, lowered expectations of a March rate cut. The euro snapped a three-week winning streak and entered the correction to leave overbought territory. Earlier, judging by the price dynamics, one might have suggested that the macroeconomic environment in the euro area was improving in contrast to the United States, but this is not the case. Friday's data showed that inflation across the bloc remains stubbornly high. Moreover, Eurozone inflation accelerated again in December for the first time since April. Meanwhile, the British pound held steady at the end of the first trading week of the year. Investors were encouraged by data on business activity from market experts. The final services PMI came in higher than the preliminary reading. Thus, traders assumed the state of the British economy as stable, assuming that the Bank of England could keep interest rates high for a lengthy period. The US dollar-Japanese chart gives a clear picture of the dollar's strengthening period, especially when market participants digest the disparity of a central bank's interest rates. Last week, the Japanese yen saw its sharpest fall in 2.5 years. In addition to interest rates, it's worth noting that the risk that the Japanese economy faced after a powerful earthquake struck central Japan and two planes collided on the runway on the Tokyo's airport. At the same time, in difficult times for Japan, Bank of Japan Governor Kazuo Ueda has fueled rumors that Japan may soon drop its negative interest rate policy. Last month, he said that the prospects of achieving its 2% inflation target seem to be gradually rising on a solid wage growth, which paves the way for a possible policy shift. The key driver of gold prices last week was market sentiment towards the dollar. Speculation about the timing of the anticipated rate cut by the Fed rate weighed heavily on the precious metal. As a result, gold posted a weekly loss of nearly 1%. Oil prices rose to $78.50 amid escalating situation in the Middle East. In addition to the conflict between Israel and Hamas and blockage of the Red Sea, protests in Libya forced a full shutdown in the Sharara and El Fil fields, which together normally pump about 365,000 barrels per day. In Iran, more than 200 people were killed in terrorist attacks against the background on a kicked off the new year of a positive note, adding almost 2%. How we're going to be in the short term in financial markets, we will definitely tell you in our news releases. Subscribe to the channel and follow news with us. And see you soon.